Welcome to this Bluewater educational video. Today we're going to discuss the anatomy of a trade. Have you ever thought to yourself, why the heck did I take that trade? What was I thinking? Well, we all have done it. We all get caught up in a moment and take a trade off the cuff. Usually ends up a losing trade, usually what happens, and you just beat yourself about it afterwards. If you have a structure for the trade, basically a way of breaking down the trade in its components, it gives you better probability for success. In Bluewater, we have a unique way of doing it, or a specific way of doing it. We look at 4 different components and a couple of rules. The first, idea level. This happens in the pre-market before trading day even starts. We do our homework, we define our trading idea, we define our levels. Happens on the chart. During the trading day, we look at setup and triggers against these areas, against these levels, based on our idea. So if you have all those 4 going for you, you have your idea, you have your level, you have a setup and a trigger, you can take your trade. That gives you a very structured way of entering a trade. Now, when you enter a trade, you need to know 2 things. First, when you're wrong, in other words, where to put your stop. And second, know your expectation. Reversal to the mean, am I looking for a reversal to the mode? Am I looking for a specific point amount? And there's no right and wrong way. If you want to have a tight stop, fine, have a tight stop. If you want to have a bigger stop, that's fine too. It's all about your own personal trading style and how much risk tolerance you got. You need to know when you're wrong though. What is your definition of being wrong? And what is your expectation of the trade? So in Bluewater, on the left hand side of the chart, you see a basic market profile. This is from August 10 and August 11th. And you can see how that Thursday, August 10th, pretty good down day. The overnight was holding towards the lows. The day session on Friday started to the downside, a little bit of strength, and ended up in the middle. Now, going into Monday's trading, my idea is going to be trading this from the short side of the market to get started. All right, so my idea for Monday is going to be looking to sell against strength for rotations back down to retest these lows, potentially take this lower. My levels are going to be against this area, 44.86, 87s, 44.95s, maybe up to 45.05s, which would be at one level above the obvious. My setup and a trigger would be a retest failure. So I'm going to be looking for a retest of this level and a potential failure to take it out. And when I think it starts failing and the market starts trading back again, I'm going to enter my trade. That's my trigger. So during the trading day on Monday, my setup and triggers are the ones I'm looking for. I've already defined my idea, which is trading this from the short side of the market. I'm looking at levels, 44.86s, 44.95s, maybe up to 45.05s would be my last level to get short against before changing my bias. And if the market starts trading lower, I'm going to be looking at buying against the 44.77, 78s, 44.68, 69s, and the 44.57, 58. With some caution. In other words, if I'm trading this from the short side of the market, I'm not looking at buying opportunities. I prefer short opportunities against strength. And if the market starts trading lower, I'm going to be looking at buying against these levels, but not very aggressively. All right, so that's downward bias means. If my bias is range bound, I'm going to be looking at fading these edges equally. No specific bias. I'm going to be looking at buying against the lows and selling against the highs. But if my bias is, as it's going to be for Monday, trading this from the short side of the market, I'm going to be looking at selling against 86s and 93, 94s, and for rotations back down again. Setup and a trigger, I'm going to show you that in a faster chart. So if I'm looking at the levels right here at 44.86s, getting short against this level would be a basic retest failure, something like this, and a failure to take it out, start trading this lower. That is my entry point. Looking at a different kind of a chart, and this is a F4 chart, but an example of a retest failure trade is right there, right? You look at this area right here, you have a rotation up to 44.88s, retest at 44.88s, green dot there, that's our retest indicator. Your failure happens right there, right at 85.50. Then this little balance bar closes and it starts trading lower. That's my trigger. I'm going to get short right there and then see if it's going to develop into a trade. Now this happens to develop into a rotation back to the mean, and that could be an expectation. It could be an expectation to run it down to the mode, run it down across the range. Could be just a specific amount of points, like 2 or 3 points out of a trade. That's your personal preference. However, on the stop side, I know when I'm wrong And that means I'm going to put my stop in right at this level. So I'm going to put the stop in above this, and if you put in your stop which matches your preferences. The target is very unique in terms of your preference. I'm not going to particularly care how much you take out of the trade. The more important part is when you're wrong. That's going to protect your account for big losing trades. If this retest doesn't work out and the market starts trading higher, I want to be out of that trade. Do I want to give myself a point, 2 points? Do I want to put in myself outside that rotation up here? In other words, move my stop up outside that rotation, give myself a little bit more room for a potential run up. That's all your part of your personal preference. However, the key thing is to know when am I wrong and leave your stop there. Don't mess with your stop. That is what protects your account. So that is part of the Bluewater anatomy of the trade. Hope you enjoyed the video, and check us out on bluewatertradingsolutions.com.